I guess we'll go ahead. Let's go ahead and start, Braxton, because one of the things we need to always start with is the disclosure screen. So I think that's actually the next slide, at least it's supposed to be, and let everybody know that we're not trying to make predictions and make promises and things of that nature. This is for education purposes only. All right, so why don't you kick us off? I mean, we titled the webinar, you know, are we going to see a recession? Are we going to see stagflation? So we got to start the webinar by just defining the two terms. So let's define these two terms, and we'll use that as our launching off point. So tell us about these two terms, Braxton.
Yeah, that's just going to be 2 consecutive negative quarters of GDP. But with what we're going to look at in a minute, it's going to show that not all recessions actually start that way.
Right. And so here I'm using, I actually pulled out my Econ 101 textbook from NC State. One of the few textbooks I did not sell back to the bookstore. So I'm actually using, I don't blame you. I probably should have. But I actually have referenced it a couple of times over the years. So this is from Dr. Hyman's textbook from 1994. Let's talk about stagflation. What is stagflation? And this is really where the difference is going to lie. So according to Hyman, this is stagflation.
Stagnating GDP along with a high inflationary economy.
So I know we have some teachers as clients. I don't know if any of those teachers are in the webinar, but any English or grammar teacher is going to have a problem with that definition because it includes stagnates in the definition of stagflation. I think that's a bit problematic. But the main point, joking aside, is recession is, the definition for a recession is mathematical. It's 2 consecutive quarters of negative GDP. Stagflation is much more squishy, subjective. So we'll come back to that in a couple of minutes. Let's keep going. So GDP. First of all, GDP is gross domestic product, for those of you that don't know. And we've been measuring our economy this way since the 1940s. I do have some problems with how this is calculated, but we won't probably have time to get into that right now. The main point is that for the first quarter of 2022, the estimate came in at, or the actual number before revisions is negative 1.5. And so the main point here is that we already have 1 quarter of negative GDP, okay? But as we were discussing a minute ago, the textbook definition of a recession is 2 consecutive quarters of negative GDP. So we could say that we might very well have already entered a recession, but let's look at some of the problems with this definition. Let's go into the next slide. Okay. So here we're talking about, this is 1974 is what's highlighted, and it doesn't show very well. I forgot to make those gray bars a little bit more distinct. But according to the National Bureau of Economic Research, the recession started in January of 1974. But we can see, if you can put your laser pointer on that, the 3rd quarter of 1973 was actually negative, followed by a positive 4th quarter of 1973, then negative, then positive. And so 2 points here. Number one, why did the recession not start in the 3rd quarter of 1973? Or why did it even start in the 1st quarter of 1974? Because you didn't have 2 consecutive quarters of negative GDP until the 2nd half of 1974. And so we're just showing this to show you that there is a problem with this textbook definition. There's been a number of times throughout our nation's history where the National Bureau of Economic Research declares that we were in a recession and it did not fit the textbook definition.
Yeah, and it's also always declared after the fact as well.
That is the other point, and we're going to talk a bit more about that. Actually, if we go back to that last slide for just a second, please. 1960, if you go show on 1960, on the left-hand side of the chart, you see negative GDP, positive GDP. Again, perfect example, another time where there was not 2 consecutive quarters of GDP. Now let's go into the next slide, and we can point the same problem in 2001. So on the left-hand side of the chart, again, negative, positive, negative, positive. So there are plenty of times where the National Bureau of Economic Research declares that we were in a recession, but we did not have 2 consecutive quarters of negative GDP. So
the question
right
is, will it get worse or will we see improvement from here?
Right. So I think our next slide, this is GDPNow. GDPNow this is from, and I should stop and pause, unless otherwise noted, all of our charts are official government charts. So all of our charts we're using, unless we point out otherwise, they're officially Federal Reserve economic data, FRED, Federal Reserve economic data. All I'm doing is I'm downloading the official data and putting it into our charting software so I can put my pretty logo on it, okay? Now this chart is also official government data. This is from the Atlanta Fed, and the Atlanta Fed started something several years ago they called GDPNow. Most of the time, the GDP numbers are printed after the fact. What GDPNow is trying to do is trying to tell us what's happening right now. Based upon the math that they're seeing, what do they think GDP for the second quarter is going to print? And so right now you can see that they're forecasting the second quarter GDP to be positive. That's good news, but positive 0.9, I believe, is where that consensus is, or where GDPNow is printing. So again, negative GDP, negative 1.5. Now, according to GDPNow, positive 0.9. Okay, let's keep moving. So again, this chart is pulled directly from the Federal Reserve website, and this is a survey from Federal Reserve board members and Federal Reserve Bank presidents. And if you can use your pointer there, Braxton, what we really want to start off by looking at is right there. In December of 2022, the Federal Reserve board members and Federal Reserve Bank presidents, they said, well, 2022, we should see GDP be approximately 4%. Now where are we at? Well, now they're forecasting 2022 to be 2.8. So they've already come down off of that estimate, as they should after a negative GDP in the first quarter. But look at 2023 and 2024's estimates, and then look at that longer run estimate, okay? So far, they have not revised those estimates, but keep those numbers in mind. It's effectively 2%, okay? So keep those numbers in mind when we talk about whether or not we're in a recession and whether or not we're in a stagflating or a stagflationary environment. But before we go on, I also want to highlight the unemployment rate. You can look at the unemployment rate, Braxton, and the December projection, 3.5% is what they were estimating, and that's where we're at right now. So that one is pretty close to being where we're at. One more point to pull out of this chart, and then we'll move on, is PCE inflation. Now we're going to show you CPI inflation. PCE is technically different. It's we won't get into the weeds on this, but in this particular chart, they're showing PCE inflation. What we really want to highlight here is the fact that these folks were suggesting that PCE inflation was going to be 2.6% this year, but they now have already revised that to 4.3. Look at what they said for 2023 and 2024. They've also revised those numbers up now, okay? And so the important point here is that Treasury Secretary Yellen just said recently that she was wrong when it came to inflation, okay? They've been behind the curve a little bit. So here's our definition of stagflation. This again is from Dr. Hyman in his textbook. But let's talk about the more popular version of this.
Yeah, the more popular version also includes relatively high unemployment, along with those rising prices and the stagnating or declining GDP. So that's the Investopedia version, a little bit more popular.
Yeah, it's definitely more popular. I don't really love quoting Investopedia. It's a little bit better than Wikipedia, but I couldn't find another definition that differed from Hyman's definition. But as it turns out, over the weekend, I think it was Sunday after church, I took my son and or our son and one of his friends to the pool. And you know, this is how I roll. What did I do? I took an economics book with me. written by a friend of mine, Dr. Richard Salzman. Dr. Salzman is a professor of economics over at Duke University. And as it turns out, I was reading a chapter on inflation and stagflation, whatever, and he also used the relatively high unemployment term in his definition of stagflation. So first thing Monday, I emailed Dr. Salzman and said, hey, this is what you said in your textbook. This is what Hyman says. I'm going to contend that we're in a stagflationary environment now, even though we don't have the high unemployment. So let's flip to the unemployment chart. And the short answer is Dr. Salzman came back to me. He's like, I totally agree. We are in a stagflationary environment, even though we are in a very low unemployment. Now, you can't really see it on this chart, but I think that's, as I say, 3.6.
Yep.
Okay. So even if you can't see the number, it does say 3.6, but what we're trying to point out is it is very, very low. Obviously, you have to remove the COVID spike from the chart to the extent that you possibly can, but we're now at 3.6%. Now, again, most of your economic textbooks are going to consider what they call full employment is when unemployment equals 3 to 4% or 2 to 4%. Again, it's a little bit squishy. It's not a firm number. But historically, the econ textbooks would say that you're never going to get 0% unemployment because there's always people that are looking for jobs that are quite frankly unemployable. Okay, so most economists would consider us to be at full employment. I would disagree with that, but this is just how the numbers are calculated. So right now, if we use high unemployment as a part of the stagflationary definition, we can't say that we're in a stagflationary environment. My contention, and apparently Dr. Salzman agrees, is that that part of the definition needs to be reconsidered, at least questioned. Let's go on. And so now we talk about inflation. So again, the definition of inflation, or the definition of stagflation, okay, includes terms like stagnating economy with persistently high inflation. Let's remove the unemployment from the equation for just a second. So if it's persistently high inflation with a stagnating economy. Now remember, what were the GDP estimates from the Federal Reserve for 2022, 23, and 24? 2%.
Mm-hmm.
That's not a robust growth. We need to be at least over 3, maybe 3.5 before that's what I would consider not stagnating. Okay, so good news here, Braxton, is we came down. We were at like 8.5. We're now at 8.2. Now we're showing this chart going all the way back to 1975, and we're primarily doing that to demonstrate that we are not in uncharted waters. In other words, we have experienced this as a nation before, but as we're going to talk about in a second, most of the people on this webinar, most of the advisors in the industry, they don't have the experience of this. They only have the historical knowledge of this, if that makes any sense. So this is the highest inflation we've seen in like the 40 years, but let's advance it one slide to really zero in on this and really help people to remember this is what folks have remembered for the last 20 years. That line, that red line, 2.5%, that's approximately what we've experienced over the last 20 years, okay? And so we are well above that. And I don't know, can we say that we have peaked here, Braxton?
No, but the Federal Reserve has backed down on the use of the word transitory when talking about inflation. So if it stays that high, it's still going to have the same effect, overall in the economy.
Totally agree with you. Okay, so yes, it was 8.5, and now it's 8.2. So yes, inflation has come down, and there are some other signs, and we'll show you those in a second. There are some signs that inflation is starting to come down, but I'm not comfortable saying that we've peaked. We could have, but it is certainly possible that we'll print another number that's going to be higher than this. But anyway, we are very elevated, and it does not look like it's going to come down. Now, this is why this chart here is why I would argue that we are in a stagflationary environment. Okay, this is non-farm job openings. Okay, Non-farm job openings are at record highs.
We've all seen it.
Yeah, I mean, you go to, you've been to a restaurant maybe, and it seems like there's a bunch of open tables, but they're not seating you. Well, that's because they don't have enough wait staff, or they don't have enough cooks. Well, that's also true in the factories. That's true in the trucking industry. That's true just about everywhere. There's jobs open just about everywhere. And so before the coronavirus crash, if you will, or correction or shutdown or whatever you want to call it, job openings was coming down. That figure was coming down, and you could see it in the unemployment chart, and you can see it here. And then obviously you got the spike down, and then it has spiked up, and it's not coming down. And I would contend this is one of the reasons why we're in a stagflationary environment, because the economy is not going to be able to grow at its potential when the factories can't make enough widgets because there's not enough people to put on the line to make the widgets. That's part of the problem. And that's, I think, contributing to this. So let's go, and I think the quits rate is next.
Right. Yeah,
What's the quits rate?
That's voluntary separations from employment. Could be retiring, could be just leaving for a number of reasons.
Yep. So this is what we do for a living. We're trying to sit down with clients and try to determine if they feather their nest enough and they can ride off into the sunset. I know we've talked about in the broader economy, we've discussed the fact that we call this the Great Resignation. My next door neighbor, he used to be a professor at NC State. He's now over at Duke. And prior to the coronavirus correction, shutdown, whatever, his wife worked at a tech firm here in the area. They have 2 young kids, great kids, but she has since decided to stop working. I don't know if they're considering that a retirement or not, but I mean, that's just a simple example of the quits rate. And so this is an Econ 101 lesson, is it not? All right, so we're going to chart the supply and demand. So why don't you give me my supply line? The supply line is the available workers, okay? The demand line is the job openings. And so we'll chart that, okay? Where these 2 lines intersect is the wage rate, okay? Now, right now, we have record job openings, right? And so what that's doing is that's shifting the demand curve over to the right because you've got all these job openings. But what's happening to the supply and the available workers? That's shifting to the left. This is classic Econ 101 right here. And so what that's doing is that's putting pressure on the wages. And so the equilibrium rate is where the 2 lines intersect. That's you can see the wage rates should be going up. Now let's take a look at it. This is wage pressure. This is average hourly wages and wage growth. Okay, so that's 5.4 on the right hand side. That's not the average hourly wage. That's the wage growth. Okay. Yeah. I was looking at this the other day with Braxton as we were prepping this. I know you and I was like, wait a minute, $5.41 an hour? No. That's 5.41%. So what we're trying to highlight here, and you just drew it, that trend line, pretty consistent wage growth for the last 10 years. Obviously, we need to remove the spikes from COVID, the spike up, the spike down, but you remove that from the equation, we're still well above trend. Why? Well, we just went through that. It's supply and demand. There's an increased demand because you got all the job openings and a decreased supply because of the quits rate. So we're getting wage pressure of 5.4%. Okay, now is that good news?
Well, it's still not keeping up with inflation, so that's going to be a problem for the average worker.
Yeah, right. Now there is a lag here. Okay, so if we got 5.4% average hourly wage growth, but you have inflation of 8.5 and 8.2, that's obviously problematic. However, correct me if I'm wrong, Braxton, if I come to you at the end of the year and say, well, inflation is at 8%, so I'm going to give you an 8% raise. And then 3 months later, I say, well, inflation is now at 5, so I'm going to take 3% back.
I might have a problem.
You might have a problem with that, right? So there's going to be a difference between wage growth and inflation because inflation can spike like that. So generally speaking, employees want to keep their wages. And next year, and as you compound, because again, in 2023, I'm assuming you want your next wage growth to be on top of the last wage growth. So there's naturally some difference between these two numbers. But if that divergence remains large, that certainly can be a problem, but let's keep moving.
Yeah, and it also leads to passing those rising costs down to the consumer as well from that employer perspective.
Absolutely, and this is one of the reasons, it's a great point, Braxton. This is one of the reasons why inflation, once it gets into the economy, it's very difficult to get out because it's a spiraling effect. Inflation is high, so employees want higher wages. And wages are high, so the bosses, the widget manufacturers, they say, well, we got to charge more for our widgets, and they charge more for their widgets, and then it causes more inflation, and it's a cycle. It's very difficult to break that cycle. All right. Again, this is directly from the Federal Reserve. This is from the U.S. Bureau of Labor Statistics. If you want, you can go back and look it up if you like. On the left-hand side, you see all items. That is effectively CPI. That's the Consumer Price Index. That includes everything. Right now, that's what, 8.2%? I always love it when the news media, they talk about core CPI. And sometimes it's as if they're justifying CPI. Well, inflation is high, but core CPI is really not as bad. Well, core CPI is the regular inflation figures minus the food and the energy. And so you can see, what is that showing for food? Is that 9.3 or 9.4, something like that? And then energy is up 30%. Right. So are you okay? I mean, are you feeling core inflation there, Braxton? I mean, do you use food and energy on a regular basis? I mean, you don't really use food and energy, do you?
No.
So I think in the government's defense, I think the reason why this started is because food and energy can spike a little bit more frequently, or a little bit more erratically, perhaps is a better way, versus the regular consumer goods, maybe not going to spike as much. But 8.2% is what we're at right now. But I know I have seen and heard lots of people even question the legitimacy of that 8.2. Forget the core number. Ted, is inflation really 8.2? So let's talk about that. So again, this is directly from the Bureau of Labor Statistics. And we've highlighted a couple of things that we're pulling out of it. Energy up 30%, electricity up 13 or 14%, new vehicles up 13, used cars and trucks up 22. Now, we did a video earlier this year, and used car and trucks were up like 40% at the time. So this is one of those data points where we're seeing inflation is starting to come down a little bit. Now, I'm not bold enough to declare inflation is going to be dead soon. I don't think that's true. Okay, but there is some evidence to suggest that inflation is starting to get under control. And I think it's going to be a long road. Let's keep going.
Yeah, hedonic adjustments are another iffy kind of measure.
Yeah. Okay, I only learned about this about a year ago. Again, taking this directly from the Bureau of Labor Statistics, when the government prints the Consumer Price Index figures and the CPE figures, they make hedonic adjustments to the math. So what the heck is a hedonic adjustment? So this is their definition. I won't read it to you. I'll try to explain it to you. My grandparents bought me a 1982 Honda Accord when I graduated high school. I graduated in 1994, so that I had a 12-year-old car. But let's just pretend they got me you got a brand new 1982 Honda Accord, and then we take a look at a 2022 Honda Accord. I have no idea what those two are worth, but let's just use some numbers. So if a 1982 brand new 1982 Honda Accord was $10,000, and a 2022 Honda Accord is $40,000, to the average American, that's an increase of $30,000. That's really not that difficult. But what the Bureau of Labor Statistics does is they say, well, that 1982 Accord didn't have anti-lock brakes. So we need to subtract that from the price of the 2022 Accord. And the 1982 Accord didn't have a MP4 input or MP3 or whatever that's called. okay? And it didn't have airbags, and it didn't have automatic windows, right? So you have to subtract those figures from the price of a 2022 Honda. But what's the problem with that? You can't buy a 2022 Honda Accord without those enhancements. So the hedonic adjustments are kind of messing with the numbers a little bit. Now, I get it, you know, not trying to throw them under the bus. There's a reason they do it, but I think we could make a case that inflation is much worse than actually printing in that 8% figure. But anyway, that's the hedonic rate adjustment. Fed funds rate.
Yeah, that's in a pretty long-term downtrend, but we're seeing that might change in the future.
Yeah. Okay, so again, this chart goes back to the 1950s, and you can see the initial trend was up. And one of the things that the Federal Reserve did under Chairman Volcker was they dramatically raised interest rates at the Fed funds rates to fight inflation. That's what they're starting to do now. But since inflation was tamed in the early 80s, we've been on this long-term downtrend as you're illustrating there. So that's what people have been experiencing these last 40 years. Most of the folks, if not every single one of the individuals that's on this call or webinar, has been there in their adult life. They've been in a declining interest rate environment overall. There's obviously been periods like in the 2000s, they started to raise rates, and we got up to that trend line and they came back down and whatever. Well, now we're starting to raise those rates again. Let's keep going. And again, they're raising the rates because they're trying to use that as a tool to fight inflation. That's what Volcker did in the 70s. That's what they're trying to do again. Now, many would contend, I would agree with this contention, that they're not being aggressive enough. They're not raising rates fast enough, and they started too late. So that is a concern. There's also that we're now starting to hear some conversations that they might actually pause the rate increases later this year. I hope they don't do that, okay? I don't think they should. Now, so far they haven't asked my opinion, but that is a concern I have is, are they going to hit the pause button on those rate increases? The point is that rates have been very, very low, effectively zero. They're starting to raise them, but I didn't add an average on this chart. I should have. We are well below historical norms in terms of interest rates. Let's keep going though.
Yep.
Gotta love those automatic lights.
Yeah.
All right. So now 30-year mortgage rates. We won't spend a ton of time on this. There's obviously a ton of correlation between the rates, the Fed funds rates and the 30-year mortgage rates. But what I really want people to zero in on is look at how the mortgage rates jumped over this last year. Now, where they're at right now is the average 30-year mortgage is approximately 5%. So is that high?
Historically, not too bad.
No, and it's from a historic standpoint, it is not bad. So if a client asks me, hey, Ted, should I buy a house? Yes, absolutely. Okay. Would it have been better if you bought a house 12 months ago? Well, yes. Okay. But there's definitely a correlation here. And why don't you go ahead and we'll show the next chart.
Yeah.
Look at that. That's new single family home sales. So single family home sales has dropped. Again, you can see a nice trend coming off of the great financial recession, or whatever they call it, global financial crisis. But here recently, they've come down. Now, give me one more slide, and we'll see directly that correlation between these two. As the 30-year mortgage rates went up, home sales went down. Do we think that's going to continue? Yeah, we do. Okay. Now, I didn't pull this math because I wasn't convinced, but new home sales or single family home sales do contribute a fair amount to our economy, because you know, you buy new brooms and you maybe new couches.
Yep. Fair bit of consumer spending that comes along with it.
Correct. Okay. So this is a concern, but I'm not suggesting that home sales are going to crater. I do think home sale prices are going to correct a little bit, but I would argue they probably should. Let's keep going. All right, yield
minus the 2.
All right, this is we're going to look at 2 different yield curves. The first one is the 10 and the 2s, and this is because this is what is most frequently cited when people are talking about the yield curve inversion. To get that yield curve inversion, all you're doing is you're taking the yield on a 10-year bond and you're subtracting the yield of a 2-year bond. When the answer is negative, there's your yield curve inversion. And the reason this is frequently discussed is, again, the gray bars indicate the recessions as denoted by the National Bureau of Economic Research. And what you'll see on before each of the recessions, the yield curve inverted, okay? Now, let's zero in a little bit because I really want to highlight 2019. So 2019, if you can show us right there, the yield curve inverted very briefly. I think it was for just a day or two. And now that we have instant news of Twitter and things of that nature, because this happened last year, or was that last year? I guess it was last year. When the yield curve inverted, I remember seeing tweets, the Insta pundits that say, hey, the yield curve just inverted. It's like they're trying to be the first to call a recession. And so there are some, not many, but there are some that say the 2019 yield curve inversion predicted the coronavirus recession. I still don't think I'm in that camp. I don't know that I'm comfortable saying that. But now we see what happened here recently is a yield curve inverted again, but it has corrected. It's now back into the positive territory. So did that brief inversion predict a recession? Or said differently, the fact that we're now positive, does that say, hey, there's not going to be a recession? I don't know. Let's flip to the next one and look at the 10 and 3s. All right, this is the 10-year yield minus the 3-year yield. And so I started taking a look at this because I read a paper from a different Duke professor, Dr. Campbell Harvey. Dr. Harvey wrote a paper, I think it might have actually been his PhD dissertation, where he was saying, disputing the fact that too many people use the 10 and 2s. They really should be using the 10 and 3s because the record is better. Again, you see the inversions, you see it goes below the 0 line leading up to the recession. But let's zero in on 2019 again. Okay, it did not invert in 2019. You can see it came close, but it did not invert in 2019. Here recently, in April of this year, it did invert. It inverted more dramatically. It has now come back positive. So again, I'm not convinced this is forecasting a recession in the traditional sense, but I'm also not convinced that this is a perfect indicator. Matter of fact, I think you and I would probably agree there's no such thing as a perfect indicator.
Yeah, absolutely.
All right. This is one of my biggest concerns. I've been talking about this for years. This is total federal debt as a percentage of GDP.
Yeah, and the bottom of this chart is not 0.
Yes, thank you.
Yeah.
Yeah. So in 1975 and 1980, it looks like we're really low. Well, it's still 30% of GDP. I would still argue that's too high. That's manageable though. Now, again, this is measuring total federal debt as a percentage. So the right-hand side of the chart is not saying that the debt is coming down. What it's saying is as a percentage. In other words, the economy is starting to grow again, so the percentage has declined. But the point here that we really try to highlight is that historically, our nation goes into debt to fight a crisis, whether that's World War I, whether that's World War II. In the 1980s, it was the Cold War, okay? But historically, after the crisis is past, the nation focuses on paying down that debt, okay? There's only been a handful of years, I think it was before the Civil War, I don't remember off the top of my head, but there's only been a handful of years where the nation was completely debt-free. So in the 1980s, you can see we were increasing as a percentage. That's that massive amount of increased defense spending that President Reagan was pushing through, okay? Now you could argue that helped us to win the Cold War. Fine, I won't dispute that. And then in the 1990s, that as a percentage of GDP, debt was coming down. That is fueled by tax revenues from capital gains on the dot-com era, stock options, and the dot-com boom. People having record capital gains taxes, so that helped pay down the debt. And I remember from Alan Greenspan's book, his first one, I believe, he actually disclosed that the Federal Reserve, when he was chairman during this time, he discussed the fact that they talked about what do we do if we actually pay off all the debt? Man, wouldn't that be nice? We haven't gotten there. So then we have the 2000 crisis, the bubble burst. We increase spending. Again, you could argue it's to fight the war on terror. Fine, I won't dispute that, but we got to pay it down. Then we have the global financial crisis. We see that massive spike. Again, you can argue that we needed to do something. Fine, but pay it down. And here we are again, going into the coronavirus pandemic. Fine, we could argue that if we want, but we got to pay it down. This is absolutely going to continue to contribute to inflation, because what it's doing is it's the Federal Reserve and the US Treasury effectively putting money into the system. They're creating money, and that is absolutely a cause of inflation. So this number needs to come down. Keep going. As I'm noticing is 1237. So one of the reasons we want to highlight this really quickly, Japan's debt to GDP, I believe, is actually 200%. So ours is about 124. Japan's is about 200. So just because we're above 100, it doesn't mean the nation is going to end or any. That's not what I'm saying, because Japan is still around, but their economy has been stagnating for quite a long time. Mm-hmm. Now, this is important from a investment perspective, because if you were a Japanese investor in 1990, on the left-hand side of this chart, it took you 30 years to break even if you were a buy and hold investor, okay? And so that's part of the reason why this is important, but let's keep going because we are gonna run out of time, I think.
Yeah, right. A lot of Americans have been deleveraging since 2008. That's really all that we're showing here. I guess we can, you have anything else on that?
Well, no, I think your point is valid. It's dead on. This chart only goes back to the 80s because that's when we have credit cards first created. Diners Club and American Express came out in the 1970s and 80s. But what you see is as we go into a recession, as we come out of it, debt gets paid down. The consumers say, hey, after the 1990 recession, that debt hurt me, so I'm going to pay it down. And so consumers paid down their debt after the 1990 recession. After the 2000 recession, same thing. Coming out of that recession, people paid down the debt. But each time it started to rise again, okay? And so then the global financial crisis comes around in 8 and 9, and what happens? Again, people paid down the debt. Has it come back? No, it hasn't. Now, some of that, by the way, is attributed to the audience, okay? There's a lot of mortgage-free people in our audience right now, because the baby boomers, the mortgages are counted in the household obligation figure, and as people are getting closer and closer to retirement, their mortgages are obviously going away. So that's part of this. Is the baby boomers are more often than not paying off their mortgage. But the bottom line, to your point, Braxton, is this is rising, but it is not yet at a point where I would be concerned about it. And I would also say that if we do see a recession, the average American is in relatively good financial health to weather that recession, assuming it's a short one.
Yep. And then consumer sentiment, that's about the lowest it's been since 2011. And then you'd have to go back to 2008 to see it at that low again.
Yep. Now, this is a survey, okay? That's all this is. This is University of Michigan survey. It's a very popular survey, but I'm going to simplify it. It's basically, hey man, how you feeling? It's a survey. It's a little bit more sophisticated than that. But the point here is that consumer sentiment does not dictate consumer behavior. It influences it, but it doesn't dictate it, right?
Okay, and Karen's telling me we need to watch time.
All right, so here's a reason why consumer sentiment is so low is because gas prices have never been higher than they are right now. At least not since the 1990s. I guess I don't know what they were relatively, once you factor in inflation, I don't know what they were in the 70s. But you know, recent history, gas prices are very high. Why?
Inventory's down, demand is still stagnant.
Correct. If demand is still the same, this chart is, this one is courtesy of Hedge. I hesitated including this because I couldn't find an official government chart, but I've seen a couple of different versions of this, not from Hedge, but from different sources, so I felt comfortable including it. But the blue line is gasoline inventory. That gray area is the 5-year range. So we are below average in terms of supply. So the demand is the same, the supply is down. That means prices are going to go up. And this started before the Ukrainians were invaded. Russia invading Ukraine didn't help, but it's not the cause.
Mm-hmm. So is gold the answer?
People frequently ask us over the years, should I be buying gold? And historically, people think gold is an inflation hedge. If you believe gold is an inflation hedge, you would then conclude from this chart that inflation must be about to be tamed because gold is not trending higher. If everybody's worried about gold and if gold is an inflation hedge, you would see gold rising. That's not happening. I would contend, again, I'll reference Dr. Harvey from Duke, that gold is actually not a very good hedge for inflation. He studied high inflationary periods, persistently high periods, and said, was gold outperforming during those periods? Now, in our nation's history, there's only been 8 time periods where we had high inflation or persistently high inflation, and out of those 8 time periods, only 1 time period did gold outperform. It happened to be the 1970s, and so there's that recency bias that we should probably talk about. People kind of remember that. And so therefore it must be true. Now, it was true that one time, but the other 7 times it wasn't true. So I'm not convinced this is telling us that inflation is not going to be a problem. I don't think it's a very good inflation hedge. All right. Most of the American consumers have been taught, most advisors are also taught, you are invested for the long term. So you should ignore the short-term volatility. Okay. So don't worry about short-term volatility. You're invested for the long haul. But Braxton, in your opinion, in your professional opinion, as a professional analyst, is this short-term volatility?
I don't think so.
That's 15
Looks like
years.
a lot to me.
That's a lot of volatility, and that is 15 years. Now, I think I've done the math. Now, we don't count dividends in this. So full disclosure, dividends are not factored into this chart. But if you did factor dividends in, it would change the magnitude, but not the answer. Okay, if you did the math start to finish, if you were a buy and hold investor during this 15-year time period, you were up about 2% on average. But the question is, did you experience anything average? No. It was a wicked roller coaster the entire 15-year time period. And the reason we're zero in on this is because this is not hypothetical. This is actual US stock market history. And more importantly, the average American has approximately a 20-year window to set aside enough money for them to be able to retire on. Those first few years out of the gate, they're trying to get their financial footing. They don't really start saving at a good clip until their 30s, sometimes even their 40s. So they've got 20 good years of earnings potential to capture the savings and set it aside. What if that's the next 15 years? What does that look like for those people that are now trying to save for their retirement? Let alone most people on our call today are already retired. What does that look like? Now, thank you for reminding me. The average age of our attendees is 63. Okay. Average age of our attendees is 63. So that means they were between the ages of 6 and 20 from this time period. Most people were not paying attention to economics when they're in that age bracket. But thank you. We also added the recession labels on this chart. Okay, And this is why I know the question is, are we in a recession? Are we going to experience a recession? But this is also, we're showing here why to some extent it is irrelevant, at least in terms of the other part of our job, in terms of managing money, because you can barely see it. I should color this a little bit darker, but there's 2 recessions officially declared by the National Bureau of Economic Research during that time period. If you were waiting around for the National Bureau of Economic Research to declare a recession, the damage has been done. And to the point that you made earlier, Braxton, they don't declare a recession concurrently. They say, hey, by the way, 6 months ago, a recession started. Okay.
So like look at that top and then the beginning of the recession here.
Right, but they probably didn't declare it until halfway through it or something like that.
Right.
So that's why this is important. Let's keep going, because the next thing we want to do is, what's that? We look at that same data, but we now adjust it for inflation. That is a 15-year time period where you have a negative trend after adjusting for inflation, but it's not over. Let's go one more slide. 1980 and 1981 weren't all that great either. That is a 17-year time period. And this is why we do things the way that we do things, but let's keep going. Okay, so there's your returns. Very ugly time period.
Yep.
Okay, that was by the way, if we didn't draw the point, a stagflationary environment. Now, that's the S&P 500 is the purple chart or purple line, and we are adding in all of the various sectors of the S&P 500. There's 11 different sectors so far. I don't know, is that teal? The XLU 4.91, that's the only sector that's positive out of the S&P 500 until we add the energy. Energy is up about 56% year to date, as of Friday, I should say. And DJP is a commodity index. It's not technically a part of the S&P 500, but we're trying to draw a couple conclusions or point out a couple of things here. Number one, the overall stock market, the broad stock market has been very, very negative, but that does not mean that your portfolio needed to generate a negative return year to date. But it does mean you need to be actively making adjustments to the portfolio so that we can get that positive rate of return. And that's what you and I are doing every day, Braxton, right? So that's where we're at. This is why your portfolio does not have to be negative year to date. But let's look at the rest of the world. This is the rest of the world. You can see that green line in the middle is the 0 line. There's a lot of countries. So this chart is showing single country ETFs. So each one of these tickers represents a country, and in a couple like ILF is the third from the top. That's technically Latin America, so it's not a single country. But most of the ETFs on the screen are single country ETFs. And what we're trying to show here is that there's a lot of negative returns all across the world. There are some positive returns. Let's flip to the next chart. I'm going to do this super quick. So ECH is the top one on that chart. Why wouldn't we invest in ECH? Well, I would say we look at that stuff, but ECH the trend changed right at the beginning of the year. And there's really no reason why we would have bought that right then, because that's suspect. We want to wait to see that a trend is firmly in place before we try to hop on board. We do not try to pick the bottom of the stock market, and we're not going to try to get clients out of the top of the stock market. But if something is trending, that's what we want to be a part of. So let's keep going because we got to land the plane. All right, now we're going to ask the question is, are we in a commodity super cycle? This chart comes to us from Martin Pring. He's another economist that a technician that I read on a regular basis. He classifies the business cycle or the economic cycle into 6 stages. And he and I would agree, we're in stage 5.
Yep.
That's a column right there. And in stage 5, historically speaking, both bonds and stocks go down, but commodities go up. Okay. So we just showed you the chart of the S&P 500 and the various sectors. Not all stocks are going down, but we have to be very, very selective in terms of where we're positioning our client portfolios. Okay. Because the bias is negative. So we have to be very careful there. but commodities are rising. So that's why we are very selective in the stock portion of the portfolio or the equity portion. In other words, we're heavily invested in energy, and why we have commodities. Why? Because those are the sectors that are working. Now, according to Pring, stage 6 would be bonds, stocks, and commodities would all go down at the same time. But that is historically, that doesn't necessarily mean that's definitely going to happen. But I know you and I talk about this every day when we get together. It's like we're trying to find a reason why the trend might be changing. Commodities have done well. Those positions that we're in have done very, very well. Well, we don't want to hold on to them if they start tanking. We want to take the gain off the table if they're going to go into a negative trend. So far, we're not seeing that. Now let's go to one more chart and determine or talk about whether or not we think we might be in a commodity super cycle. This is not an ETF that we're invested in. This is one, this is just another ETF. It's a good measure for commodities in general. The problem is the data only goes back to 2006, but it does go at least go back that far. The point that I'm trying to show is where we're at right now with this commodity dates back to 2012, okay? And so it wouldn't surprise me if commodities pause at this level because we're facing what we call a resistance level from all the way back in 2012. But you can see they have been on a tear since the bottom of 2020, okay? So there is some argument to say, and I'm not convinced this chart is doing it justice, but there is some argument to say that we could very well be entering into a commodity super cycle, right? We'll see, but let's keep going because we're running out of time. We're going to skip this, not enough time, and we should probably just start answering questions. I did just get one. Basically somebody chiming in, hey, because of that chart DBC, should we be invested in that? Well, we're invested in commodities, just not that particular one. And the one that we're using is, and do we have the disclosure slide? Because we should be showing that at some point. Is it not in there?
Don't think so.
All right, well, we got to figure out a way to put that in there. Yeah. The commodity, we're in a couple of different commodities, actually, commodity ETFs that are trending well. We're just not in that one, but there's a reason, by the way, that DBC one kicks off a K1. That's one of the reasons why we're not using that ETF, is because we try very hard to avoid ETFs that kick off a K1 when at all possible. So can we substitute? Yeah, so David is asking a question, can we substitute the labor participation rate for unemployment? That's a very good question, and that's basically part of the reason why I'm saying we have to look at the job openings. Okay, so it's labor participation is also job openings. Because those two things are as elevated as they are, that's why I'm going to argue that we are in a stagflationary environment. And again, we go back to what the GDPNow and the Federal Reserve is estimating. When they're estimating GDP to be about 2% for the next 3 years, that is a stagflationary environment. Now, next question is come kind of off topic, but a good reminder. TD Ameritrade has been bought by Charles Schwab. I think most everybody knows that. We talked about it very early when we launched into the independent channel, but somebody asked us a question not too long ago that was kind of surprised by it. Sorry if that was a surprise. We've been talking about it. I'm not sure how that got missed for that particular client, but in our sense, we're pretty excited about that merger because we know some of the technology on the Schwab side. By and large, it's not going to affect clients. So there's really nothing that you are going to need to do, Mr. and Mrs. Client. It will affect some back office things on our end, but our argument is it's a good thing. It'll improve. We do expect some improvement in some of the client experience, and we're looking at making a couple of other changes as well. The other question was about 5498s. A lot of clients just got a IRS form 5498 in their mail. a lot of our clients have been with us for a long time. When we were with the former firm, that firm had a habit of sending Form 5498 with the regular tax package, but 5498s are not required to be mailed until May 31st. So it's a for informational purposes only document. You don't need to do anything with your 5498s. It's not a bad idea if you want to give it to the accountant that's filing your taxes, but it's not required. So you don't need to do anything. It's just the former firm used to send it out in advance. And when you made a Roth IRA contribution in February for the prior year, then the firm would have to send you a new 5498, and that caused even more confusion. TD Ameritrade just takes the stance that we're not going to mail them out until we're required to mail them out, because you do not need a 5498 to file your taxes, and we don't want to send amended ones out anyway. So you don't need to do anything with it, but again, not a bad idea to give it to your accountant. All right, another question. I find this one a little, the question is effectively, with the stock market continuing to tank, where are we proposing to put our money to at least keep from losing money? I looked at the account that from this particular question. The account is positive year to date. A lot of our models are positive year to date, so we're not losing tens of thousands of dollars in percentages. We're actually doing quite well. Over the last couple weeks, I have met with other advisors, with other firms, and just chatting. And when I mention our models and what our models are doing, they're like, wow, how are you doing that? Well, we're doing that because we're doing our job. We're actively managing portfolios. We're not afraid to sit in cash when cash is appropriate. Some of the rules in the industry by some firms, notably the one that we used to be affiliated with, would force us to be fully invested at all times. Okay, well, the bond portion of our portfolio has been in cash all year long. Well, I'm glad, because bonds have been down all year long. That was a good decision. So we like the way our portfolios are positioned. Most of our models are positive year to date. The model that's the most negative is one that is for our smaller accounts. But Braxton, just a week or two ago, you and I made a change there to those models because, and I won't get into the details, but the point is that is trending well now too. So we like where we're positioned right now. Okay, so what are we doing with all of this data? That is a great question. Thank you, Chris, for that. So what the point, one of the things that we are trying to describe with this information is, it is important for you and I, Braxton, is it not, for us to have an idea of where we might be going, but that doesn't dictate that we do anything today. Okay. What we're looking at in terms of a client portfolio is, for simple explanation, we're looking at price. If the price is going up, we're good. Price is going down, not good. So it doesn't matter if the National Bureau of Economic Research is saying we're in a recession or not. Now, one of the things that you and I were talking about yesterday, Braxton, was didn't you see some survey that was talking about like the majority of Americans fear that we're going to go into a Great Depression?
Yep, sentiment is very low.
Sentiment is very low. And when you have something like this survey that says the majority of Americans believe we're headed for a Great Depression, not a recession, the word was depression, we could make an argument that that is what's called a contrarian indicator. I think it was Warren Buffett that said something to the effect of, at maximum pessimism, be a buyer. And at maximum greed, be fearful, something like that. And so when sentiment is as low as it is in that University of Michigan survey, there's an argument to say that might be a buy signal. Now, that's not what we're doing. We have different signals that we're looking at, but one could argue that they're contrarian indicators. And now that we have more and more people that are declaring a recession is around the corner, there's an argument to say we might actually technically see one. I'm not in that camp. I think we're in for a stagflationary environment for at least the foreseeable future. But what does it do? What do we do with it? Well, we're looking at the same things that we're always looking at. We're looking for trends. What's our favorite cliche? There's a bull market somewhere. I like to add, there's a bull market somewhere. It's Braxton's job to go find it, right? And so
as
that's
long as my wages keep up with inflation. Yep.
That's right. And so that's what you and I are doing on a regular basis, is we're looking for those bull markets. If the United States market is down, but Chile is up, well, let's go get some Chile, right?
Yep, and Karen is just signaling that we're running low on time.
Yeah, so we'll end it here. I know I didn't get to all of the questions. I'll continue for just a second after I wrap up. If you are watching us after the fact, we hope you will, click the like button on our YouTube channel. That the algorithms do help when people click the like button. Everybody should get a survey after this webinar. We ask that you would fill out the survey, give us some feedback on how we're doing. If you want us to do more of this, anything like that would be very helpful feedback. Obviously, we are pretty pleased with how our models are performing. And I know clients are very pleased with the advice that Nathan and Paul are giving clients. So please don't keep us a secret. Feel free to introduce us to others, because others are not experiencing the same thing. That many people are having very negative losses in their portfolio. And we're not experiencing that on a broad level. Overall, our clients are pretty happy with where performance is at relative to the broad markets. So with that said, thanks for watching, everybody. And we hope you will tune in the next time. Feel free to ping us. If you have any questions, by all means, feel free to reach out. And I guess on that, we will wrap up. Although I did say I would answer the question on impact to RMDs. The impact to RMDs is, there's arguably not going to be much of an impact to RMDs. The government's still going to make you require minimum distributions. And it's the same rules that always apply. But anyway, that said, thanks for everybody for watching.
Yep. And thanks everybody.
Yep. Bye.